Hello everybody, this is Lenska with Lenska Realty, and this is another edition of the San Diego Real Estate Market Update for July 2020. I also serve on the board of SDCIA, which is the largest investor club where we help investors get educated in promoting success in real estate investing. I'm a full-fledged real estate broker and help buyers and sellers achieve their goals in their investment strategies or with their real estate transactions. Please don't forget to hit right now the subscribe button, as this market update is at least monthly. We're looking at the reopening in reverse, and just a reminder, I'm not a fortune teller. All I want to do is help you build your fortunes. I will bring you graphs, stats, numbers for a factual understanding of real estate market in San Diego. I know we have numbers that are pretty bad coming in for unemployment. We also have increasing bankruptcies and increased zombie companies, and banks are already writing down a lot of losses. Plus, look at China is in quarrels with about 21 nations and also has an agenda for just China first. All right, so the world seems to be a different place, but there is no place like home. So just to make a point to just how bad this COVID-19 crisis is, it is so bad that even the IMF downgraded the US GDP to minus 8.0%. Just to give you some numbers, we have about a 3 trillion collapse in our GDP. We have a 10 trillion estimated fiscal and monetary response, which meant that the Fed's balance sheet grew from 800 billion in 2008 to 7 trillion currently. So the 10 trillion is a 2020 estimate, which translates to nearly 50% of GDP. So this crisis is kind of our third world war, and currently we're still fighting a health war, which means we have increasing total cases, and we have still increasing deaths, and the red marked countries are still increasing, oranges are still increasing. So very few countries have the coronavirus under control. So it is ebbing in some of the countries, but it's growing faster than actually ever, with more than 100,000 reported cases each day. But we're looking to check what the real estate market is doing. So the sales and inventory numbers, interest rates, employment data, HPSI by Fannie Mae, homebuilder sentiment, affordability. Practically, if you have a job and you still would like to buy a house, that's what you do. And so we're not having any graphs or stats on that, but we will talk about foreclosures and forbearances. Sales and inventory numbers, we're going June. All right, we have a median home price of $605,000, which is an increase of 2.9%. We have a median home price for detached up to $687,000 at 2.5% increase. The median home price for attached was also slightly higher at $453,000, which means it's a 3% increase. Yes, you heard me right. These have been increasing as the graph shows. So we had a median home price at for detached at 670 June of last year. So this has been the highest median home price in history. We're still selling 26 days. Pending sales have recovered. In April, we were slightly down compared to 2019, but in June, we were up 20%. So people say we have all that pent up demand. Now, we will have better closings coming up because we have a sharp increase in pendings in June. We came up from 2,900 units in May to about 3,642 in June. So that one that was down here in May, nearly the lowest ever. The detached looking also pretty strong. Our inventory is down 50% year over year. We were coming from 3,158 in May to 2,585 in June. So inventory is now it's actually the time where our inventory typically, the peaks here is typically the months, the summer months. So obviously our spring selling season has just started, but we do not see any inventory increases. In order to obviously have better deals, and especially for investors, we have to see an increase in inventory, which we don't. And again, in attached, we're also down about 30%. Same story here. We only have a 1.8 months supply. In order to have a balanced market, we're looking at about 5 to 6 months inventory. I believe there is not one state in the country where we have a balanced market. Also very strong, you see, if there's no price pressure on, if the sold price is within the 98% range of original list price. So here, was the story of the comeback after the shutdowns, and everybody was struggling to how to show houses and trying to wipe them down, and with masks and gloves and all this stuff. So the blue line is the new listings, and the green line are the pending. So you can see in the May week 3 and 4 and the first week of June, we saw actually more listings hit the market than went pendings. But then second week on June, the real estate market is on fire. So you see that pendings overtook new listings, and especially in the last week of June, and even during the holiday 4th of July weekend, we saw the pendings shooting up and our inventory disappeared. So if you're sick and tired of house hunting, a lot of people are actually buying an RV, and the American road trip is back. So as you guys can see, maybe if you would have invested in some stocks in RV companies, and you would have in Winnebago or Thor Industries, you might have had now a nice down payment for a home. Mortgage rates, we are finally below 3%. Last week or 2 weeks ago, it was in the news that United Wholesale Mortgage made national news that it announced that it would be offering interest rates as low as 2.5%. Okay, not everybody gets it. Remember, there is a requirement for a certain credit score for down payment, and never before, and any lender as big as UMV, the country's biggest purchase mortgage lender and largest wholesale lender, offered rates that low. You're asking yourself how? And we know every answer is right now because of the Fed's doing. So what did the Fed do? The Fed, which has taken action in the last 2 weeks, indicating that it's now ready to buy mortgages or mortgage-backed securities with interest rates below 3%. So if they are buying bonds or 30-year mortgage bonds in the 2 to 2.5 point range, which the Fed has not previously bought, then it makes sense that lenders are offering below 3% interest rates. So lenders are having the time of their lives, as you guys see, between like 2014, 15, 16, 17, 18, even into 19, the lenders were not making a lot of money on the refis. But lately they're going to make up for it, as also not only purchase applications are up, but they are swamped with refis. As I mentioned, mortgage applications are up. So now we're looking at our employment data. The US unemployment to stay stubbornly high around 12 to 18%, and it really depends on who you ask, which stats you pull. So it's really hard to come up with a definite number, as these numbers seem to follow a narrative, and I can't believe it. But I'm going to show you a few different ways of looking at the unemployment, because we know if you don't have a job, you can't qualify for a mortgage. So we still need to look at the unemployment numbers. So according to Bloomberg, 30% of jobs lost from February to May are a result of a reallocation shock, which means those jobs could be gone for good. So the outlook gets even worse, as Bloomberg estimates that 37% of jobs in the hospitality and leisure industry could be permanently lost. That number could reach a whopping 56% for the retail industry. So here are initial claims are down in California, but they're still 6 times higher than they were before the crisis. And don't forget, government came up with a PUA, which is Pandemic Unemployment Assistance, which is a special program for business owners, self-employed, independent contractors, or gig workers not receiving other unemployment insurance. So we have about 13 million that we need to add to other unemployment numbers, and also the continued unemployment claims are still very high. They came down a little bit below the 20,000, but still on the above any year's level. SANDAG reported 15% unemployment in San Diego, certainly an improvement from May 9th, where we have seen it at 25%, as this hit our leisure and entertainment industry pretty hard in San Diego. Hopefully all the being able to eat on the, or expand the restaurants to the parking lots and other creative ways will help our restaurants and small businesses. Now, the temporary or permanent job losses, this is the big question. So the last recession, it took us, looking at the blue line, it took us from 26 months over to 7. So it took us 5 years to come back to at least the 0. So right now we're so low. We will see a V recovery depending on if we can stay open or continue with the reopening plans. But let's see how people feel about real estate. And this is the Home Purchase Sentiment Index by Fannie Mae. It considers the following questions. Is it a good time to buy or good time to sell? Will home prices go up? Do you think mortgage rates will go down? And how confident are you about not losing your job? And do you think your income will be higher than in the past 12 months? And which is good, the HPSI increased 9 points to 76.5% in June, and this is the second month of improvement in June, allowed the HPSI to regain some of the sharp losses we have seen when the COVID-19 crisis started. So the share of renters who say it is a good time to buy is the highest level it has been in 5 years, and good time to buy, 61% are thinking it's a good time, which is a year-over-year 11 increase of an 11, and month-over-month 21. The sellers also have a slight increase, thinking it's a better time to sell months over months, but still they're still sitting on the sidelines a little bit with a minus 50 year over year. And if we're looking at other data here with the survey respondents, persistent, substantially elevated concerns about job security in the face of record unemployment remains a key takeaway. And which means every other person is not concerned, which is 74% are concerned and 26% are not concerned. So that shows in this graphic. So people are worried about their job, 48% today versus 73% before February. I don't think it's a surprise, but that will finally end up showing up in some price reductions or leveling off of the median home price. Now, how many people are really working? So there's another way of looking at it, and maybe looking at it as in 51% of employees who were working at the beginning of January were working 4 months. We're working 4 months later at the beginning of May. So this is 51% right here. And that's pretty dismal. But it improved considerably in June after reopening, when we saw 77% by the end of June. But obviously, it's in absolute terms, it remains pretty bad to have 23% of workers still jobless. Or should we look at that? Look at the job openings, which is fewer, and which also means there are fewer opportunities to get a job. The gap between 2019 and 2020 right now is minus 25% job openings. Or I could put it also another way. When we look at the employment to population ratio, which is right now 52.8% of Americans have a job. It is the second lowest level. Last month, 51.8% was the lowest, actually, since the labor statistics start tracking the figure in 1948. So the reason why people like the employment to population ratio, it is because it can't be manipulated like a lot of the data in the monthly job reports. But who wants to come back to work if the current federal unemployment benefit of $600 per week, assuming a 40-hour week, it equals $15 an hour plus the state portion, which obviously varies, however, how much money you made before. So that means the bottom 30% of the US workers are better off keeping unemployment as long as they can, which means that's what Congress right now is debating, right? What should be the new stimulus and how much should the Fed contribute to the unemployment? Home builders are back up. It's jumped up 21 above the 50 mark, and also we have seen some increased filing and building permits again. Now we're looking at foreclosure and forbearance. Still 8.8% of mortgages are in forbearance. So it has leveled off for a while, but then we saw a slight increase in the second week of July, which means 79,000 loans were added in the last 2 weeks, which also means we have $1 trillion of unpaid principal. So we also see the highest increase in the FHA and VA loans. So mortgage servicers are struggling as they need to advance up to $3.5 billion a month to holders of government-backed mortgage securities. And that's on top of the $1.4 billion in payments they must make on behalf of the borrowers. Remember, just because the borrowers are not paying, that doesn't mean that the mortgage servicers don't have to pay the investors. So we're looking, and this is a schedule, we're looking at about when are these forbearances expiring. So they were supposed to expire in a bunch of them, 50% on June and July, also many, not so many then in August. So I'm wondering what will happen now. Are they going to ask for an extension? Funds run out pretty soon, right? So most of them were filed just for 3 months. Even so, they had an opportunity to file up for, I believe, for a year. But delinquency rates are up. San Diego is in spot number 32 at 6.7%. But maybe more deals are to be had in Mississippi, Louisiana, New York, New Jersey, Florida, and Hawaii. And notice, Florida just finished their last foreclosures from the last crisis because those are judicial states and it takes much longer and has to go through the court system. But again, our courts now are still closed. So that's why we don't see any foreclosures yet, because there are moratoriums and the courts are closed. And what's the takeaway for this month's market update? The economy is propped up by the Fed. We've seen a coronavirus resurgence. We also see a reverse of the reopening. Unemployment is stubbornly high and a lot of uncertainty in the job market. But the coronavirus yet has to infect the housing market, as there was a lot of pent-up demand which showed up in pendings and an increase in median home price, at least for right now. Very tight supply kept the pressure on price, but the saving grace were the low interest rates make housing the bright spot in this crisis. And wait, there's more. If you like to learn how to become a smart investor, please join us on Meetup in our group, Real Estate Investing Field Trip, where we analyze and evaluate real estate investments for maximum profits every third Saturday for each month for the last 12 years. Or if you like more stats and graphs and the economic outlook and when prices will decline, join us Monday night's Zoom call. We think real estate investing, also found on Meetup. Thank you for listening. Don't forget to hit the like button. Don't forget to subscribe either.